this strategy so profitable that it got me this win, this win, this win, and all of these wins. Not only that, but this strategy is set up in such a way that every single time you use it, it gives you risk to rewards that are absolutely insane, meaning you're risking way less to receive way more. And by the end of this video, you'll be able to replicate this strategy and use it yourself. To understand this strategy, we have to understand two concepts, and one of those concepts is market structure. Now, every single chart you will look at will all follow the same market structure theory. I don't care if you're trading stocks, crypto, gold, it's all the same. Every chart will have uptrends where the chart is moving upwards, every chart will have downtrends where the chart is moving downwards, and every chart will have consolidation between the two where price is moving sideways. It's pretty simple actually. We only want to enter long trades in uptrends, and we only want to enter short trades in downtrends, and we want to avoid consolidating markets like the bubonic plague. Now, I know what you're thinking. While looking at this picture, it's pretty obvious that this is an uptrend and this is a downtrend. So you might be sitting here thinking you're wasting your time by watching this part of the video, which it is pretty easy to spot uptrends and downtrends when you're looking at the past. But when you start trading in real time, it can be a lot more confusing and not as straightforward to identify these trends, and you're way more likely to make a mistake. But there are a couple little tricks you can use to help you identify these trends not only faster, but a lot easier too. To dumb it down a bit, an uptrend will look like this, where it's making higher highs and higher lows, where price is continually breaking the previous highs. When price breaks these highs, this point is called a break of structure, meaning it's breaking structure of the previous high. A downtrend is the complete opposite, where it's making lower highs and lower lows, creating breaks of structure to the downside. Now, as you already know, all good things must come to an end. We know when a bullish trend is coming to an end by watching the higher lows. So, for example, our latest higher low is marked by this line, and when price makes a break of structure of this higher low, we can then expect it to make lower highs after this, which is the start of a new downtrend, leaving you with something that looks like this. Then the whole process repeats itself forever. And if you look at any of your charts right now, you'll see the same formation all over your chart. So I did say there were two main concepts to this strategy. One of them is market structure, which is what we just went over, and the other one is liquidity. And this part is arguably the most important step. But first, let me show you a site called Hanker Trade. Ever heard of it? They're a Forex and crypto broker that have extremely low spreads and low commissions, some of the best on the market, which who doesn't like saving money on commissions? They also have an extremely friendly support team who will answer any type of question you have. And the best part, they are running a special promo where if you sign up with the link in my description, they will match whatever you first deposit. So if you put in $100, they will match that and give you $100.
That sounds like a deal.
Sign up with my link and make sure you use that special promo. So going back to the video, liquidity in its simplest form is just orders, and orders are what move the market up or down. Without orders, the market wouldn't really move. So liquidity literally is what gives the market fuel to move. So if you have a setup like this, it's pretty common knowledge that you'll have sellers at the highs and buyers at the lows. Whenever these buyers and sellers enter into the market, they will also be finding a place to set their stop losses.
Oh, that's hot. That's hot.
So think of it like this. If you're a buyer and you bought down here at this level, it is very, very likely that you'll place your stop loss below this low, as if price goes below this low, it would now be considered a downtrend and you don't want to be in a long trade anymore. And a lot of other traders will be having the same exact mindset and doing the same exact thing. So there will be a lot of stop losses in this area, meaning there will be lots of resting liquidity in this area right below this low. Same goes for sellers up here. If you're shorting from up here, you'll most likely be placing your stop loss above this high, creating resting liquidity above this high. So now we have two areas of liquidity. So if you're looking at this chart, where is price most likely to react? Well, if you said in the middle area, you're probably wrong, because price is most likely to react where there are large numbers of liquidity. And where are there large numbers of liquidity? At the highs and lows, meaning price will always try to target and take out liquidity liquidity. If you start to view trading like this, it'll make your life so much easier. So what's most likely to happen, price will go up or down to the resting liquidity to try to target it. Once it hits this liquidity, it'll most likely try to target the liquidity in the other direction. So in other words, you can think of liquidity as almost a false breakout. Then once that happens, the process keeps repeating itself on and on again. So remember in the beginning of the video, I was going over how to identify market structure. We went over uptrends and downtrends, but we never really went over consolidation, which is when the market moves sideways. And what I just taught you about liquidity ties perfectly into consolidating markets. Because if you have a chart like this, where we previously were in an uptrend, and then price starts to move sideways, creating equal highs and equal lows, this will naturally create huge pools of liquidity. So if you're trading like the majority of people do, you're going to be placing your stop losses down here below these lows if you're in a long trade. If you're in a short trade, you're going to be placing your stop losses up here above these highs, which means there's resting liquidity above and below this consolidation, and price will only have enough fuel to break this consolidation if it breaks into one of these areas of liquidity. So as a potential trade, we want price to hit one of these areas of liquidity, then start to look for a potential trade setup in the opposite direction. As we know, price will always target liquidity. So for example, if price hits this upper area of liquidity, we would then look for a potential trade setup to the downside, since there will be lots of stop losses fueling this move to head lower. Same goes for the opposite direction. If price heads downwards first into this lower area of liquidity, we would then look for potential trade setups to the upside. So now that we know what both market structure and liquidity are, let's combine the two and make a strategy out of it. So first things first, we get a chart that looks like this, making higher lows and higher highs, and it's made breaks of structure to the upside. So since this has happened, we can easily see we're in an uptrend and we only want to take long trade. Next, we need some form of liquidity so we can make sure there's enough fuel for our trade. After this uptrend, price does this, where it created these equal lows. And like I said before, whenever there are equal highs or equal lows, that will mean there's lots of resting liquidity in those areas. Another point, since we're in an uptrend, we want our liquidity to be towards the downside. Because like I said before, you want to think of liquidity grabs as almost like a fake out. So if we're in an uptrend, we only want to look for long trades, meaning we need to see a fake out to the downside first. So we get lots of liquidity, and only after that, we look for a potential trade setup to the upside. Okay, enough of that silly line stuff. Let's go to what you've all been waiting for. Let's go to a real life chart example. To start us off, the chart did this, where it's making higher highs and higher lows, making breaks of structure to the upside. So we now know we're in an uptrend and we only want to look for long trades. But this isn't really enough for us to enter yet, so we need a bit more confirmation. Next, price goes down a bit and does this, where it starts to trade in a zone and move sideways. Now, like I said before, we never want to trade inside consolidating markets, but if we look a bit closer, down here, price made equal lows. And like I said, with equal lows, that creates tons of liquidity. So there will naturally be huge amounts of liquidity below these lows. Also note how this liquidity is towards the downside, which is exactly what we want when looking for a long trade. So next, we want price to break these lows to get liquidity, which is exactly what happened. So we got our uptrend, we got our liquidity, next we need to find a place to enter. To do that, I see a beautiful demand zone right here. If you're not familiar with supply and demand, I made a full video going over just that. You can click it in the top right hand corner of your screen to watch that video. For a simple explanation of supply and demand though, it's just an area where price consolidates and has a huge strong push in one direction. Where we place the zone is just the start of that move. Price does exactly that on this chart. So we'll mark this area as our demand zone. Price comes perfectly down to our demand zone, we enter the trade, we're going to set our stop loss below the demand zone and set our take profit at the high of the original move. And just look at that risk to reward ratio. Let the trade play out and we get a super profitable trade. Similar situation here. Here we have a downtrend because price is making lower lows. So now we know we're only looking for short trades, which means we need liquidity heading towards the upside. Here we got equal highs, which is absolutely perfect because now we have tons of liquidity above this line. Wait for price to break these equal highs. Now we need a place to enter. There's a beautiful supply zone right right here, price comes up to our area of supply, enter here, set your stop loss above the area of supply, set your take profit at the low of the original move. And just like that, we got a beautiful winning short trade. Here's one last example. First, we need to see what trend we're in. We're making higher highs and higher lows, so that means we're in a long trend and we only want to look for long trade. Next, price does this and consolidates, moving sideways. While doing this consolidation, price makes these equal lows, which is absolutely perfect considering we're looking for long trades. We want our liquidity to be towards the downside. We want price to break this liquidity, which is exactly what happens. Then we need a place to enter. There's a nice area of demand right here. This is where we enter. Set our stop loss below the area of demand, set our take profit at the highs. We get a beautiful winning trade. Try this strategy out yourself and let me know how it works for you. By the way,